Mega cap tech also under pressure the last 3 months as investors shift from growth to value a little bit. But our next guest believes that the Mag 7's dominance may not be over just yet, and he is especially bullish on Google, which he says is the cheapest it's ever been compared with the S&P 500. He's Chris Grisanti, Chief Market Strategist at MAI Capital Management. Chris, good to see you. Take us through your thesis on Google here. It has not been the superstar of the Mag 7, but it hasn't been the real turkey either. I guess Tesla has that crown.
Sure. Well, Tyler, it's good to be with you again. And I hate coming on here and recommending Google because I'm a value guy. And plus, you know, what value do you add by recommending Google? Well, I'll tell you, if a value guy likes it, maybe somebody ought to pay attention because it's trading at its cheapest multiple relative to the S&P in its entire history. So let's pull the camera back. I think the economy is actually not just in decent shape, but in really good shape. The first spate of earnings that we've just received from the financial companies, they're terrific. And when you guys are talking about United Airlines today, not only is it up 11%, we've got an airline buying back over $1 billion worth of stock. I can't remember the last time that's happened. So the economic indicators seem really strong to me. At the same time, in a month, we'll have the election behind us, and that's going to be a positive no matter who wins. So if I think the economy is going to continue well, where are the strongest earnings going to come from? They're going to come from these technology and communication stocks. As a value guy, I'm sorry to say that, but it's true. So which ones are lagging? Google is lagging. It's got a terrific, almost monopolistic position. Don't tell the FTC I'm saying that. And they have Waymo that you get for free, and it's selling at, it's 17 times next year's number. I think it's a no-brainer.
So I guess the question would be, it's trading, as you say, rather more like a value stock than like a growth stock. It is at historically the lowest multiple it's been relative to the S&P 500. But does it deserve to be, in part because of what you just mentioned, one of which is the antitrust worries that this company may face?
Sure. I got to tell you, I'm old enough to remember owning Microsoft in the late 90s when they were under the antitrust scrutiny. By the way, that stock tripled during the duration, the 6-year duration of that antitrust case. So don't let that dissuade you from an otherwise really good investment. Of course, do the math yourself. But I think this is a great chance to buy a stream of earnings that are pretty reliable at a really attractive price.
Do you think that Google's primacy as the king of search is as secured as it has been over the past decade and a half, or either through government action or just market action, others may come and creep up and nibble away at that moat?
That's a terrific question because you're asking exactly the right question. It's not the government I'm so much afraid of as the market, which innovates much faster than an antitrust case will move. Are they going to come up with other search engines? Is Apple going to not make Google the dominant search engine on the iPhone? Those are the important questions. I think the answer is that Google will retain its space, do your own work. But I also think at this price, you're getting paid to take that risk.
You also didn't want to leave the stage without mentioning your affinity for Pfizer, which has a lot going on, including a very nice dividend, by the way, so you get paid to wait, but also the entrance now of a potential activist in the shares. Why Pfizer?
Well, and you're absolutely right. I didn't want to leave the screen without saying, no, I'm really a value guy. I'm also liking Pfizer at 10 times earnings. This reminds me of our pick 18 months ago of Verizon, which is done just terrifically. You get paid about 6% to wait. There's a lot of ways to win. If you can go from 10 times earnings to 14 times earnings, get the dividend for a couple of years, you'll make 50% even if the market rolls over. This is not a very market-sensitive stock. The second thing is in an election year, these healthcare stocks tend to suffer. And then in the following year, as plans unravel for more healthcare spending, these stocks tend to rebound. So we're counting on that. And I just don't think there's much downside here.
All right, Chris, thank you so much for your help today. We appreciate it.